Good day, and welcome to Nature's Returns, a webinar speaker series hosted by the Yale Center for Business and the Environment. My name is Andrew Wu, and I will be your host for today's webinar titled Paying for Success, Financing Forest Restoration in the West. The Yale Center for Business and the Environment, or CBE, is pleased to continue Nature's Returns, a webinar series that addresses the growing importance of ecosystem valuation and investment. Each presentation is recorded and available on YouTube and Yale iTunes U. We are pleased to have Zach Knight with us today. Knight is a co-founder and the managing partner of Blue Forest Conservation, a boutique deal development and asset management firm focused on conservation finance. Prior to founding Blue Forest Conservation, Knight began his career at Merrill Lynch, where he worked in structured finance and credit derivative structuring. After a subsequent 4 years as a high-yield and distressed bond trader, Knight left Wall Street to earn an MBA with honors from UC Berkeley's Haas School of Business. Today, Knight will showcase the Forest Resilience Bond, an innovative financial vehicle developed by Blue Forest Conservation that invests in forest health to alleviate drought and wildfire. By applying a pay-for-success model to forest restoration, upfront costs are shifted to private investors, with beneficiaries such as the U.S. Forest Service and utilities repaying investors based on the success of the treatments. The Forest Resilience Bond aims to create positive environmental and social impact through reduced wildfires, improved water resource management, and job creation, all while generating competitive financial returns. Before we begin the presentation, we would like to remind our listeners that questions are welcomed and will be directed to our speaker at the conclusion of the talk. You can type questions directly into the GoToMeeting chat window. And with that, we welcome Zach Knight to Nature's Returns.
Thank you, Andrew. Before I get started, I want to say that I'm really humbled and honored to be presenting to your group today. I went back and looked through some of the past speakers here. You have folks like Joe Whitworth from the Freshwater Trust, Lori Wayburn from Pacific Forest Trust, Ricardo Bayonne from Encourage Capital, who's actually a partner in developing the Forest Resilience Bond. And I mention this because these are all folks that have decades of experience and a lot of accolades and a lot of accomplishments under their belts. And it's a very different situation for me and for our firm here. I'm very new to the space. Blue Forest Conservation is just over a year old. And the Forest Resilience Bond is something that's actually still under development. But I hope that that provides for a better conversation as we get into the Q&A, and I very much look forward to everybody's comments, feedback, questions. And I would just mention some of our best development has actually happened from people telling us why this won't work. So I welcome that as well. As Andrew mentioned, my background, recent graduate from Haas alongside the rest of my team from Blue Forest Conservation. And I did spend the better part of a decade on Wall Street prior to coming to business school. And it was a great experience. You get your finance chops there, which I think is incredibly important in the conservation investing and the environmental investing and more broadly in the impact investing space. And one of the reasons I went back to business school was, despite I loved working on trading floors and it was a really wonderful experience, I didn't have a lot of purpose behind what I was doing. And I think that's one of the reasons that the rest of my team and I founded Blue Forest Conservation are so excited to work on this project. So I want to tell you a little bit about how this started before I jump into the presentation. We actually started working on this as a student project for the Morgan Stanley Sustainable Investing Challenge. And that's not just a business school competition, it's open to all graduate students. And the goal is to create an institutional scale investment structure that furthers sustainability in any way, shape, or form. It's a competition that was created by Dave Chen from Equilibrium Capital and has been shepherded by the folks at Northwestern and Morgan Stanley. I actually competed in this both years during my MBA, and it was one of the best experiences I've had. So for any students listening, I highly recommend that you check this out, especially if you want to get into this space. So our second year of doing this, we were fortunate to win that competition, and the real prize associated with was getting to present this at the Milken Institute Global Conference, which is the premier financial conference for those outside of the space. And from there, we had an hour and 15 minutes. I was dodging financial structuring questions, which are actually very validating for the financial structuring guy. on the group, we had so many folks come up to us afterward and say, you need to go forth and you need to make this happen. And from there, we were lucky to team up with Ricardo from Encourage Capital, as well as a fellow named David Groves, who'd been working on this for a couple of years at Private Capital for Public Good, and actually earned a grant from the Rockefeller Foundation that was subsequently joined by the Packard and Fink Foundations to support our work. So with that, I think I'll jump into the presentation here. So what we're going to run through today, the introduction is sort of the problem, solution, and then I'm going to come back to a problem. The next section is called Contracting with Beneficiaries, and this is where we're going to talk, it's only 2 slides, but we're going to talk a little bit about pay for success, draw some similarities to social impact bonds here, and hopefully this will form a good basis for questions if that's where a lot of the interest lies here on the other end of the line. And then lastly, I'm going to get into the investment structure and talk a little bit about why private capital is so important in making this happen. So I like to start with these images because I think they provide a pretty sobering look at what 50 to 100 years of well-intentioned fire suppression policy has done to forest density in the western U.S. In California, and actually many other western watersheds, we have up to 10 times as many trees as nature intended because we've disrupted the natural fire regime. That would, say at a 5 to 25 year interval, burn at low intensity and severity, removing small trees and shrubs from the forest while having really limited impacts on the old growth. And it's this density, when combined with an increasingly hotter and drier climate, that's created the tinderbox conditions that made 2015 the worst wildfire season on record. Unfortunately, this is no anomaly. The 5 worst fire seasons have all happened since 2004. And while we're not only seeing more acres burned, we're also seeing these fires happen at higher severity, which in some cases leaves the forest unable to ever recover to their natural state. As many of you know, forests also provide substantial water resources, and at the same time we found ourselves at odds with catastrophic wildfire. The vast majority of California and western states are also in severe or extreme drought. This adds up to water quality issues, sedimentation, declining yields in watersheds, impacted ability to store carbon, and actually leaves much of the hydropower infrastructure that's already in place in these states grossly underutilized. Moving forward, this tells you much of the same story called the evolution of forest density. I really like this because of the images that you see here. You see this forest transition from 1909 to the density that you get in the lower right-hand corner in 1978. And pay attention to that date. This is how much has happened over those 70 years, but we have an additional 40 years of overgrowth on top of that picture you see in the lower right-hand corner. So, you know, in that prior 2 slides, we mentioned the threats to watersheds, and I think the key takeaway here is that these watersheds are systems. They become less productive, less efficient, less reliable for the water and electric utilities that are tasked with managing them. But finally, there's good news, and we needed some good news after that. The solution to forest density, and it happens to be forest restoration. This is an everyday activity of the Forest Service, other state and federal land managers, conservancies, nonprofits, and NGOs. This restoration, also known as thinning, is simply the removal of small trees and shrubs that contribute to the intense wildfires that consume much needed water resources. You often hear this referred to as fuel reduction treatments as well. So this work has been shown to reduce the risk and severity of wildfire, protects water quality, and even show increase in water quantity in some watersheds. At the same time, these restoration activities have the opportunity to create a number of direct and indirect jobs for the rural community, where in California, unemployment can be as high as, say 15, 16, 17%. I think there's also a big opportunity, we're not going to jump too much into it in this presentation, to further develop some of the biomass infrastructure in California and other western states. And until we start to scale this forest restoration and really have a steady supply of biomass, these small trees and shrubs coming out of the forest, it's going to be hard for folks to make the necessary or requisite infrastructure investments in biomass. So moving on, if this is an everyday activity of the Forest Service, why isn't it being done? And I guess I should pause for a second and say, why are we focusing solely on Forest Service land? Well, I think one of the big issues, first of all, the Forest Service is the largest forest manager in California by a landslide. But also the Forest Service land that they manage tends to be at that medium to higher elevations, which certainly has severe risk of fire, but that's also where the headwaters for a lot of our water resources in California come from. And most importantly, it's where the snowpack is stored, which is why we've really decided to focus on Forest Service land. But what we'll describe in the coming slides really could work well on private land, on other federal agency land, or state land. So as I mentioned in the introduction here, we're sort of going problem, solution, problem, and this sort of brings us back to the problem. The Forest Service is tasked for funding this restoration on National Forest System land, but they've had an incredibly vicious budgetary cycle. If you look in 1995, the Forest Service spent about 16% of its budget on fire suppression. That number ballooned to 52% last year in 2015, and the Forest Service projects that will exceed 67% by 2025 if this is left unchecked. And this is really the vicious cycle where the Forest Service is forced to pay for today's fires by borrowing the funds that are designed to prevent tomorrow's. So you've heard me refer to a lot of the benefits to utility stakeholders, a lot of the water benefits, and what we're really talking about is increasing watershed resiliencies for these water and electric utilities. We've talked about quality, we've talked about sedimentation, we've talked about declining yield or perhaps increasing water quantities. Some of the things that don't get mentioned as much are the actual damage to infrastructure that you see from fires. And actually, most importantly, is the timing of the flows and the runoffs. And this is important to both water and electric utilities. Even if we don't actually see more water coming through a watershed, there's a great deal of value to delaying the snow melt for both water and for electric utilities. On the bottom of this slide, you see a blue line that's well below all the other lines, and that's California's hydropower generation in 2014. I can promise you that it looks much worse in 2015. And you know, it goes to show you that we have all this hydropower infrastructure in place. This used to be over 30% of California's energy supply, and I think it dropped to about 10% last year. And these are getting grossly underutilized because of the drought and because of some of our forest health issues. Also, sedimentation in these reservoirs can be a huge cost. Going through and dredging a reservoir, it really increases the cost of managing that and reduces the life of these reservoirs. So here is the second part of the second problem. And one of the questions is, why can't we do this at a greater scale and a greater pace? And I think the simplest answer is that because we have a single payer system where the Forest Service is forced to fund all of this work. And mind you, the multiple beneficiaries, that pie chart is really just illustrative. I think there's other beneficiaries in addition to water and electric utilities. I think you could say the state is a beneficiary in a lot of cases, in terms of reducing carbon emissions, creating jobs, a handful of other things that we probably don't have time to get into, but also insurance companies as well. So we're just using this as water and electric utilities, but I think there really are many more beneficiaries than what you see here. So by having the Forest Service be responsible for this funding in California in Region 5, depending on who you talk to, the Forest Service does somewhere between 200 and 230,000 acres of restoration a year. By the Forest Service own standards, if they're not doing at least 500,000 acres a year, we're going further into overgrowth in our forests, and this forest density problem is going to continue to get worse and worse as time goes on. And when you think about, in California alone, we have sort of 6 to 9 million acres in need of restoration. So to address that overgrowth and that backlog of work, we really need to be doing somewhere in the ballpark of 1 million to 1.5 million and perhaps more acres of restoration each year. And again, the consequences of inaction, we've talked about these, water available for downstream users, quality issues, and the risks that these fires threaten utility infrastructure, communities, and also natural habitat. So the Forest Resilience Bond, our approach is to take these beneficiaries and allow them to repay for the benefits they receive over a 10-year period, with private capital coming in to fund all of the restoration costs. That's important. We're going to talk a little bit more about that as we get into the investment structure, but we believe this is the only way that we can actually scale restoration to the pace that it needs to be. And again, we want to get well beyond that 500,000 acres a year, but this is how we're going to take small steps to get there. So a couple of the key elements here is that utilities are only tapped to pay, and state and the Forest Service, once the work is completed. And by doing this cost share, we think we can give everybody, you know, a quote-unquote good deal, and ask them just to pay for a portion of the value that's being created. And that's the nice thing about this approach. Forest restoration really does create an incredible amount of value. And lastly, and this is sort of a key issue with private capital, this allows the work to take place at the scale that it needs to without any legislative changes, without further appropriations or any changes to the Forest Service budget. And I think that's a really key fact here or issue, because what we have is a problem of immediacy. We urgently need this restoration to happen, and we need something that can accelerate the pace and the scale of restoration today, not 10 years from now.
For those in the audience that are just joining us, Zach Knight from Blue Forest Conservation is presenting on the Forest Resilience Bond. So far, we've established the challenges of drought and wildfires facing forests in the western United States and how the Forest Resilience Bond can address these challenges with its innovative financial approach. Zach will now delve into a deeper discussion of the Forest Resilience Bond's hybrid approach of combining conservation outputs with conservation outcomes.
Thanks, Andrew. So I only have 2 slides here in the contracting section, but I think they're really important, and I hope they form the basis of a conversation during the Q&A on social impact bonds, how to use pay for success, some of the things we can learn from social impact bonds and bring that into the environmental space. So the first thing that everybody needs to get acquainted with is the language here. Credit goes to Professor Paul Gertler from UC Berkeley. This is what's called a theory of change. People use different terms. I've often see outputs replaced with outcomes and outcomes replaced with impacts. But I think if I talk you through this, this will sort of make sense to everybody. So in our example, the inputs here are the investor capital, the contracts with the stakeholders, the restoration crews, so on and so forth. The activity taking place is the forest restoration work. The outputs are what can be simply observed from this happening. And the best example of that, and one that we'll come back to a lot, is number of acres successfully restored. The outcomes then are much broader impacts of doing this work. It's avoided carbon emissions, it's avoided fires, avoided fire suppression costs, protection of water quality and quantity, creation of jobs, so on and so forth. So differentiating those outputs from the outcomes is a really important thing as we take the next step here. So traditionally what you'll see in social impact bonds, especially those aimed at lowering recidivism rates, is an outcomes-based approach where you have to have a randomized control trial to really prove that a treatment group and a control group, that there were better results from this financing. And that's a great way to do it, and you can prove the attributability of actually doing this intervention. One of the problems with that is it's incredibly expensive to evaluate. And in our case here, if we want to call the intervention the forest restoration, often the investors get stuck with another risk that they're not really paid for. And that comes up all the time when we talk to fixed income folks. What if it never rains again? So we could have a forest restoration activities that were incredibly effective, but what if it never rains again? What if there's no more precipitation in the state of California ever again? Well, we'll have a lot of other problems, but I think that's a really draconian example of some of the problems with a fully outcomes-based approach. So it's expensive, sort of recapping here, it's expensive to monitor this. Your downside protection is very low, but if it works, investors get to share in all that upside, so the upside potential is actually quite high. In outputs-based approach, I think this is something that looks a little bit more like an infrastructure financing. We're going to track the acres that are successfully restored, and then payments are made based on that. Much simpler, much cleaner. Your downside protection is very significant there. If the work gets done, you as investors get paid back, but you don't get to share in any of the upside. And the nice thing, again, is the monitoring and evaluation of that is very simple and straightforward. So what we have proposed with the Forest Resilience Bond is really to take a hybrid approach. We think that one of our big learnings, and again, this is a project that is steeped in stakeholder engagement. One of our big learnings from this is that both investors and the beneficiaries that are the payers in these structures actually don't want fully outcomes-based payments. They don't want the volatility in the cash flows if they're investors, and they don't want to not know what they need to pay if you're the utility or the state or the Forest Service in this structure. So by taking a hybrid approach where we time the majority of the payments, the principal repayment in this case, to an outcomes-based approach, which if the work is successfully implemented, the investors will see a return of principal in this structure, and then the upside. So if this really works well, the investors will share in some part of that upside to sort of form the returns in this structure. We think this is the best way to move forward. And I want to say before we move on to the next section here is that the first transaction, the pilot or the demonstration deal that we do, will look and feel very different from deal number 2, 3, 4, and 5. So this is very much a living, breathing, developing, dynamic process. So this is the ideal. This is what we would love for it to be down the road. The first transaction, the first one we do, might be fully outputs-based, but it's a step in the right direction, and sort of bringing all these folks together is what's most important.
We've reached the latter half of our webinar and welcome those just joining us. Zach Knight from Blue Forest Conservation has introduced the Forest Resilience Bond and explained its underlying motivations. In the next 15 minutes, he will describe the financial structure of the Forest Resilience Bond and explain the company's strategy moving forward in the next few years. We would also like to remind our listeners that questions are welcomed and will be directed to our speaker at the conclusion of the talk.
Great, thanks, Andrew. Before I get into investment structure, I think we need to talk about why we need private capital to make this happen. The first two, I think, are obvious. We have hundreds of billions of dollars in private capital, in fact, more than that, probably in the trillions, that could be tapped and used to fund interventions like this if we create the right deal structure and we make this look and feel like something investors are comfortable with and have invested in the past, which is why you'll hear me talking a lot about an infrastructure-like financing with investment-grade counterparties. Obviously, the Forest Service does have those budget constraints that we mentioned, and this will allow restoration to happen at scale without any legislative changes. I think the bottom two are a little bit more important. When you want to do cost sharing, being able to do it on an ex post basis, meaning after the benefits have already been received or recorded, that makes it much more enticing for beneficiary stakeholders to come to the table and to take part in some of these financings. And we also have the potential to set precedent. We can really change the way restoration is funded and really let finance lead policy in some ways here. And lastly, I'd say, especially as we look towards a pilot or demonstration project, private capital and potentially foundation capital in a first transaction can allow this to take place at lower risk for all of the stakeholders that are part of this. So this is sort of a crude, high-level visual of what this financing will look like. I'm going to run through it with you quickly, and then I want to point out a couple of important points here. So simply, the investors fund an investment vehicle, which then in turn funds this restoration. Depending on the size and the scale of what we're doing, we expect that restoration will take somewhere in the ballpark of 1 to 2 years to complete. We'll be evaluating this, whether it's on the output or the outcomes basis that we talked about before, and those watershed resiliency benefits will accrue to water and electric utilities, as well as to Forest Service and states. The contracted cash flows, which I'll show you an example of that in just a second, will be they'll be 10-year contracts, which matches pretty closely the valuable life of doing this forest restoration, with annual payments made by all of these counterparties back to the Forest Resilience Bond, which then will pay interest and principal to debt investors and residual cash flows to equity investors. So 2 points in the structure that I think are worth talking about, and I'd be happy to answer more questions on this in the Q&A portion, but because we're taking this output-based approach and something that looks a little bit more like infrastructure, we have the opportunity to fund this a little bit more efficiently and de-risk the structure a little bit. And what I mean by that is that the equity portion of this will likely fund first, and once we hit implementation targets, we'll be able to draw down on a loan facility from the debt investors. And the reason that's important is once we hit these implementation targets, debt investors will have a very clear vision as to where their repayment is going to come from, which lowers the cost of funding this. There's also a substantial amount of credit enhancement with the equity capital already being in play, so we're hopeful that that will lower the overall cost of the structure. The other thing that we have to be cognizant of as what's different from most typical infrastructure financings is we don't have an asset behind this. We don't have a hard asset that debt investors can take possession of. What we do have is contracted cash flows. So what we've done from a structuring standpoint is structure this such that the debt and equity investors will basically receive both interest and principal and amortize over the life of the transaction, such that there's no refinancing risk when these deals come to an end and we actually want to renew this structure and go back in and redo this work in a watershed if it's needed. The other thing is we have one simple arrow from the investment vehicle to forest restoration saying that it's funded. Well, yeah, it's funded, but how it gets funded, I think, is equally as important. We'll be working through implementation partners, which could be NGOs and nonprofits. It could be conservancies. It could be state fire departments like CAL FIRE here in California. And this is helpful for a couple reasons. One, no one would ever trust 4 MBAs to implement forest restoration work, and I think for good reason too, and you've got to understand your limitations here. But also the Forest Service has a real backlog or real challenge in contracting. And they don't have enough contracting folks to actually hire all the restoration crews that are needed. So by bringing in implementation partners to manage this work, which is allowed often by the Good Neighbor Authority in California and others, to implement this work and actually fund some of this work on Forest Service land, that's a way that we can get around a lot of the implementation risks in doing this. So I'm going to quickly talk about some of the sources of cash flow here. One that you'll see smack dab in the middle is biomass. For our initial transactions, we're actually not assigning any value to the biomass, and I think that's important because there have been some other projects and stewardship contracts that the Forest Service has given out where they've potentially overvalued biomass and using that as a way to fund the work, which can slow down the work in a lot of ways. So hopefully that will become a cash flow in this transaction, but we're not counting on that the first time around. And I think that's a whole nother conversation that we really don't necessarily have time to get into. The other benefits, we know the fire severity, I know it's over there as sort of a one-time cash flow, but that's really spread out over the life of the deal. Same thing with water benefits and hydroelectric benefits here. On the bottom half, we have some of the cash flows that we think could be brought into these deals or other similar deals that aren't likely to be recognized in the first transaction. The big one you see down there is carbon. Obviously, we're doing this on federal land, so this is not eligible for a carbon offset. We're also reducing vegetation, even though I think there have been enough studies to show that doing this forest restoration work actually is net carbon negative. One of the other ones you'll see down there is insurance and reinsurance, and this cuts two ways. First off, insurance companies have actuarial risk, both in home insurance and private timber stand insurance, and in other states that own more state forest land, there's some insurance at the state level as well. So they would benefit from reducing that risk that they already have on the books. Another issue that's really paramount in California, in the wildland urban interface, we often will have lower income rural communities that can't afford fire insurance. Often the only thing these folks own will be their home, and if that home is destroyed in fire, what next? So if we can lower the fire risk to the point where they can afford premiums, that's actually new business for an insurance company. They're not going to write premiums unless they think that's a good business decision, and it will achieve, I think, a more important social impact goal for the state here in California. Mitigation banking is something, again, not part of this structure, but certainly could be, especially if we moved into lower elevation lands where we might have less water benefits. So I think that's something to keep in mind. And new market tax credits, again, not going to be applicable everywhere, but creation of jobs, there can usually be some payments that are associated with that. So again, these are just illustrative cash flows, and the big takeaway here is, one, the fire suppression payments are probably going to dominate the cash flows in this, and the fact that we have real annual cash flows, which is what allows us to create a real fixed income instrument here. Thinking back to social impact bonds, for instance, they're called a bond, they're structured like a loan, you really have more of an equity payoff profile. Our goal here in structuring this is to have real, tangible annual cash flows. So let's talk a little bit about the market opportunity here. In 2014, the Forest Service spent just under $800 million on restoration. If we were to go out and do all the restoration that needed to happen in California, that would be over a $5 billion opportunity. And if we went out and restored all 58 million acres in the US, and I've actually heard that number up as high as 80 million acres, this would be a minimum of a $40 billion opportunity. Now, caveat that with the fact that maybe 10 to 15% of this are real watersheds where we'd see this structure in its specific form work. But again, transferring in mitigation banking or permits could allow this restoration work to happen in other places. And even if we just do this in watersheds, that's still a 4 to 6 billion opportunity. The impacts here: hydropower generation, water quantity and quality, fire severity, air quality, and jobs, just to recap those one more time. So I want to talk a little bit about the advantages of this structure of the forest resilience bond here. And this is looking at things in a lot of ways through the lens of an investor. What we really need to show is that the deal size are substantial enough that they warrant investors taking the time to do due diligence. And that can come in two forms. Either we have much larger transactions, or we have transactions that are highly replicable and highly scalable. So for an investor coming in to look at these transactions, they're going to see, okay, I see I have the Forest Service as a partner in each one of these deals, I have the state, and I have the utilities, and they're all following the same contracting scheme as the first deal I looked at, and the second deal I looked at, and the third deal I looked at. We think we're actually going to be able to have both here, where we do have larger transactions and things that look and feel very similar, but that's incredibly important from the investor standpoint. Again, I mentioned this on the cash flow side. This is a real fixed income asset. There's real annual cash flows that support that debt tranche. And by amortizing that debt tranche over the life of the deal, you don't have any refinancing risk. And I think that's really, really important. Once again, we will have some credit enhancement from an equity tranche here to support the debt tranche if there are any losses in the structure. And I think from a portfolio diversification standpoint, this isn't going to look or feel like anything else in an investor's portfolio. The multiple payers here, this is sort of contrasting with social impact bonds once again, where you generally have one payer and it's the government. The multiple payers provide much more robust economics, and you still have those high investment grade counterparties. And lastly, we talked a lot about outcomes and outputs, and I think the ability or the flexibility to contract on both of these is a real advantage for this structure. So talking about the timeline and sort of where we are right now, so we're still in the development stage. Again, very fortunate to have Rockefeller Foundation, Packard Foundation, Fink Foundation supporting this work. And a lot of our work right now is relationship development, which takes a long time at the state and federal level, nailing down the contracting scheme, and also working through the deal structure. Our goal in the next 12 to say 24, maybe 36 months is to have one or more pilots up and running. And what we really want to test with that is, one, can we actually implement this restoration work? Two, can we measure the benefits? And we've got some great academic partners that we're working with to do that. And three is the contracting scheme. Can we actually get the Forest Service and the utilities to all come together, figure out what the contracts need to look like in a way that investors are happy with that as well? I think these pilot transactions will probably take on some blended capital. This will be program-related investments from philanthropy, perhaps some government grant funding that comes in, and hopefully some market rate capital as well. Going out 2, 3, 5 years and on, what we really want to see is this model scaled across California and the Western U.S. and reach financial sustainability, not just for our transactions, but also for us as a firm and for our partners. And the deal revenues, which are fees charged to investors, are what will support us. And we want to make sure there really is a market rate of return for all of our investors in these transactions. So with that, I will wrap up right here, and I guess turn it over to Andrew to open it up for some questions.
Zach, thank you very much for your talk. We have some questions from the audience and colleagues that we would appreciate your input on. To start off, I would like to dig in a bit more into the question of biomass infrastructure, which you touched on earlier in the presentation. You mentioned that past proposals have overestimated biomass revenues, which is why you've started by assuming that biomass is not a significant revenue stream. Could you elaborate a bit more on this?
Sure. And again, Andrew, I want to caveat this by saying I am not an expert in biomass markets or in the wood product industry, but what you'll see a lot of times with the Forest Service is that it's expensive to haul the biomass off. And once you get beyond sort of a 50 to 100 mile haul range, the biomass, especially if it's being used for cogeneration purposes, is no longer valuable to ship it any distance further than that. So what happens is a lot of times this gets left in the forest and, say, burned in December when the fire risk is much, much lower. In other areas, they've tried to do what's called a stewardship contract, where the Forest Service will have contractors come in and, this is how they often will do timber sales as well, where they pull merchantable timber out of the forest, and the Forest Service can actually get paid for that. So we achieve some of the restoration goals by doing that. What's happened is finding the higher value use for the biomass has really been the challenge. Finding the use for it where it's worth hauling it over 100 miles, or having enough of a steady stream of that biomass to make the requisite infrastructure investments to put biomass facilities in these forested areas where the restoration is going to take place. And I think if you look at California, for instance, and you look at the planned actions for the Forest Service, there is a year and a half to maybe 2 years of shelf-stocked permitted deals that are unfunded. And if you were an investor and you were going to invest in a biomass facility doing something else, maybe besides generation, higher value use, sustainable building materials or wood dowels or what have you, you'd want to know when these are actually going to happen, because you'd want a steady stream of biomass coming out of the forest to make your investment worthwhile, which is why this is a little bit of a chicken and an egg. If we can show investors that would make those private equity or infrastructure investments in biomass companies and biomass facilities, that we're actually going to create that steady stream, that might elicit some investment from those folks. And I think that's a really, really important point here. And that's going to be a big issue. And everybody that we talk to in the Forest Service talks about this as a challenge. The state talks about this as a challenge. And I think it's been a challenge in other states as well.
Thanks, Zach. I'd like to turn the conversation over to the issue of risk. And to start off, you mentioned earlier that this resilience bond structure will ultimately lead to a no refinancing risk. Could you explain further what this means and how long it would take to reach this goal?
Yeah, so refinancing risk is, we can talk about risk more broadly than that, but what I mean by refinancing risk is generally in an infrastructure transaction, you'll have a hard asset that as you develop that asset, you can go back to the debt capital markets and refinance it, especially if the project is going well. You can refinance it at a much lower rate because you have a hard asset, a building, for instance, behind your financing. What we have here are contracted cash flows, not a hard asset. So if we're going to have deals that run the course of, say, 10 years, we need to make sure that the debt and the equity returns that we're projecting here are fully made available to investors by the end of that 10-year period, which is why we are going to both service and amortize the debt tranche and take a 10-year debt investment and probably see something with a weighted average life of closer to, say, 4 or 5 years. And I think that's really important, because if you had to go back out to the capital markets to refinance this with new contracts, but you still had to pay for new restoration work to take place, that would make this really, really challenging for investors. So we need to make sure that we avoid that.
Gotcha. Moving on to another form of risk, I'd like to talk about the implementation partners that are meant to minimize implementation risks. How are you establishing those partnerships and incentivizing investment by these partners in forest restoration work?
Well, it's a great question, Andrew. So these implementation partners don't necessarily have to be investors. If you think about how the structure works, and I'll flip to it. I know this is a little crude, so I don't know how helpful that is, but we would be passing funds from investors through an investment vehicle to these implementation partners to actually contract with the restoration crews and have this work done. So they might well be investors. If we work through a state forestry department like CAL FIRE here in California, there may be some state funding coming back in to repay investors, but those implementation partners don't need to be investors themselves. They'll be party to the contracts with the restoration crews, and they'll be helping to implement this work, but they don't necessarily need to be paying for it. Does that make sense?
Yes, it does. To build on that previous question of partner buy-in, can you also speak to the scoping work that's been done to assess beneficiaries' willingness to participate?
Yeah, it's a great question as well. So what I would say is that this has really been a stakeholder engagement exercise for us. And you think about it, we find ourselves with our sort of development partners encouraged, sitting right in the middle of this, where we're talking to the Forest Service, we're talking to the state, we're talking to both water and electric utilities, both public and private. We're spending a lot of time with academics to understand the science behind this. How can we project the value? How can we measure and verify that? And then this engagement actually will need to get down to the community level, where these planned actions are actually going to take place, talking to fire safe councils and other groups in these communities to make sure when we're going in there and doing this work, we're doing the rural development in an appropriate way. So the way that we've created buy-in, and I think I think this has worked really well for us. It said, we obviously have this big problem and there's no other alternatives. We're not at the position anymore where we can just let it burn. We need to find a way to come together and collaborate. And we actually think that the financing and the opportunity to bring in private capital to address this issue that wouldn't be able to be addressed in any other way at this point is what's actually bringing folks together. So we're not forcing anybody to come to the table. It has to be a collaborative approach. It won't work other ways. But if you think about it, this could be in a situation where finance actually gets to lead policy in a way and bring all these folks to the table. The other thing that I would mention here is that when talking to utilities and others, it's a little bit of an economic argument in that if this work happens, they will see benefits, but at the same point in time, this isn't land that they necessarily own or manage. Often it's Forest Service land. So why should they be required to pay for this work if it's on Forest Service land? And I think that's where you need to make the economic argument, saying that this work probably isn't going to happen unless you come and you chip in and you pay it for a little bit of the value that's being created on your end. And as long as we can leave a lot of value on the table for each one of those stakeholders, and fortunately we can because there's so much value created from this forest restoration work, we have a much easier time of bringing folks to the table. But that's something that's ongoing now, Andrew. So, but that's sort of our approach to it.
Thanks, Zach. I'd like to talk a bit more about the history of forest restoration deals. Could you talk about any such deals done in the past that may bear resemblance to the Forest Resilience Bond and how they are similar or different from the resilience bond that you offer?
Yeah, that's a great question. I actually have an appendix slide for that, so let me flip through and find that. So here's an example of this. I think the one that's most often talked about is the deal that Denver Water did with the Forest Service. I think they did this exclusively for water quality issues after the Hayman fire in Denver a couple of years back. And what was done here, and this is kind of similar to water funds that you might see, but the utilities put all of the money, in this case just Denver Water, split the cost of doing the restoration with the Forest Service and put all that money in up front. And that was great, and that allowed them to control the process along with the Forest Service, and I think that's worked well for them. But in our mind, if a utility is willing to put that money on an upfront basis, why wouldn't they be willing to pay something less than that much money and pay it over time? So I think that's a pretty good precedent. In Flagstaff, we saw a ballot measure where taxpayers paid for some of this restoration work. 4 Forest Restoration Initiative is funded with a stewardship contract focused on the wood products industry. And I should also mention that the National Forest Foundation, they have one coalition in California, but they've got a really interesting project that folks should look into, the Northern Arizona Forest Fund, that's doing some great work and actually bringing in philanthropic capital to fund this. And they've got some great partners working on that. But I think the one thing that sort of stands out with all these transactions is that the only deal that has upfront capital providers being private investors is our Forest Resilience Bond, and it's also the only one that incorporates pay for success.
Great, thank you. We have a question from Carolyn from the audience. What is the most surprising or unanticipated stumbling block that you've run into trying to pull these deals together?
I don't know if I should answer that because I'm sure we're going to have many, many more coming our way in the future. I'll give you one example, and I think we turned this into a little bit of an asset, but we were meeting with a utility, and this was very early on in the process, and we had just started making some of the academic connections to the folks that have written all the paper about the water quality and the water quantity benefits, and we were really just getting to know those folks, and we presented this to a utility that fortunately for us was very friendly, and about 5 minutes into the meeting they said, "We believe the benefits are there, but we don't think you can measure them the way that you say you can." And we said, oh, well, that could be a real problem in bringing this structure to market. And then they actually suggested saying, well, what if we paid on an output basis? They didn't use the term output basis, but it was the same idea. Or what if we made some payment based on each acre restored? Because we know there's real value in doing this. We just don't think, given our measurement capability in our watershed, that you can actually measure this down to the acre foot of water that's being generated from doing this. And I think this is a good example of someone telling you how this won't work and then sort of getting over it with a suggestion of what might work better for them. And that's a big part of any stakeholder engagement process is saying, we have this idea, but then taking a step back and really listening. and hearing their points of view. And that's been the biggest learning for us, is learning to speak the language of all those stakeholders and understanding what's really important to them.
I see. Moving on, we'd like to talk about the issue of scale. One of the touted challenges of the conservation investment space is scale, because many projects are unable to capture the attention of larger institutional investors because of their current limited size and impact. You've talked about the Blue Force model, having great potential to achieve scale. Now, what limits to scale are there, if any, with this particular model? Are there regulatory or geographical constraints that the model is particularly dependent on?
Yeah, there's a lot of, I guess this is sort of harkens back to risk a little bit, I think, Andrew. For us, it can also be a resource limitation. I mean, we're a small team. We're very fortunate to have partners and encourage and actually be working with the World Resources Institute as well. I think when you start to look at what a utility needs, for instance, to take part in these transactions, they may need a strong economic analysis to make the case to either their public utility commission or their ratepayers or their shareholders and investors as to why this is worth it. And that's why we need great partners like the World Resources Institute to help with some of that work. Other risks to scale, I think permitting is one that comes up in every meeting with the Forest Service. And one of our sort of takes on that is that if we can actually bring the Forest Service and state, and they actually work pretty well together in California, I don't know what it's like in other states, but if the state agencies and the other federal agencies come together and collaborate more, we're going to have an easier permitting process. And think about it this way. If you're going to do a small pilot transaction or a demonstration project on, say, 5,000, 8,000, 10,000 acres within a watershed, while you're taking the time to prove that out and the Forest Service starts to make their first cash flows, the utilities and the state start to make their first cash flows, while that's going on, you have a year or 2 years to get the permits that you need in place to take this up to the watershed scale. So in essence, by working together with all these stakeholders to bring the pilot to bear in the first place, you can also start the permitting process and basically build in a pipeline of future transactions. So I think those are the two, and I think it comes back to infrastructure, but we don't want to really get into biomass again necessarily. But that is certainly one of the infrastructure constraints. But I would focus mainly on making sure stakeholders have what they need in terms of economic analysis and other things, and then the permitting.
I see. Now, earlier in the presentation, you mentioned the value of leveraging blended capital. In addition to the new market tax credits, what are additional public sources of capital that could be stacked with the forest restoration bond?
Good question, Andrew. And when I said blended capital, I didn't necessarily mean public capital, although, I'd say there are plenty of grant programs available from the USDA that if we were to do this on private land, and we really do need to take an all lands approach to this. Again, I've told you why I focused on Forest Service land initially, especially in this presentation. But if you look at the land base in California, it's a checkerboard of private and public ownership. And without bringing private parties into this, we can do all this great restoration work on Forest Service land, and the fire could start on private land and then sort of get out of control just the same. So we do need to take an all lands approach, and I think there is a good amount of government capital and grants that would be available specifically to private landowners, or potentially even state or municipal landowners as well. When I was talking about blended capital, I was more talking about, especially in the early rounds of these financings, of bringing in philanthropic capital, probably in the form of program-related investments, perhaps credit enhancement grants, to make it more tenable for any market rate investors that come into this structure, or if there's no market rate investors at all and there's a slight concessionary return on the first transaction, just to prove that this works. And I think the nice thing about this is, even if we have 5 or 10 year transactions for the demonstration, you don't necessarily need to show all 5 years or 10 years of track record before you can go on to do your next deal. In a lot of ways, by raising the capital and by having the contracting scheme in place, which the investors, whether it's PRI investors or market rate investors, and the utilities and the state and the Forest Service all coming together and agreeing on the contracting, as long as that implementation goes well, you should be able to move on to the next transaction without needing to wait for a full 5 or 10 year period to see the full outcome of the transaction. But that's what I meant for on blended capital, was talking a little bit less about public funds. And public funds come into this structure, right, as the Forest Service is paying investors back. So there is that element of public funding already in this. And I think public grants a little bit less so unless we're talking about different land base.
Great. Thank you for clarification. So a question about bond performance. In measuring bond performance, can you speak to the differences between counting the number of acres restored versus specifying which acres are restored? What methodology does your team use in prioritizing areas for this restoration work?
It's a great question, and you are certainly asking the wrong guy, Andrew. So in terms of payment and financial structure, it will be based on whether the work is successfully completed. That said, where this work takes place is really up to both the Forest Service and the academics that we're working with. The Forest Service has forest plans for each one of their forests. We would in no way aim to change that whatsoever. The forest supervisors and the district rangers lay out these plans. There's years and years of surveying that go into that. And when the Forest Service is ready to take action, they have something called planned actions that then go through the permitting process. Additionally, we're working with some great groups in the UC system and at Stanford that have that resource economics background, but also hydrology and GIS mapping, where we can go in and say, this is where we think you'll get the best bang for your buck from a hydrological standpoint. Can I explain to you right now how to do that over this webinar? I can't, but that's why we work with a lot of people that are much, much smarter than I am.
You and I, me both. To end this webinar, we would greatly value your advice for other organizations and individuals working at the intersection of ecosystem service valuation and conservation investment. What key lessons have you learned in your process of developing the fourth resilience bond?
Great question. So the first thing I'd say is team up with people that are smarter than you and get yourself some great partners between the academics, folks like Encourage and WRI that we're working with. I'm working with a lot of people on a daily basis that are a lot smarter than I am, and I think that really, really helps us move the ball. The other thing that I think is important is as you go and engage stakeholders, you don't have all the answers and you don't know what they need and what their incentives are. Maybe you do if you've worked in that industry for 10 or 20 years. I certainly didn't, and we certainly don't, and we're learning from them. And by starting the engagement process, by learning a little bit more about these stakeholders, what they need, how they value things, you're going to end up with a much more collaborative approach that I think will help get some of this work done. And I want to make one more plug for the students out there. For any folks at Yale, you guys always do well in that Morgan Stanley competition. I'd highly suggest that you check it out. And again, it was one of my best experiences as a business school student.
And with that, we conclude the talk on financing forest restoration in the West. Once again, we would like to thank Zach Knight for joining us today. If you wish to view a recording of this webinar, please visit the CBAY website or access the recording through YouTube or Yale iTunes U. Thank you for joining us. Until next time, this is Andrew Wu from the Yale Center for Business and the Environment. He